Welcome to the Deep Dive, your way to really get up to speed on complex topics quickly.
Glad to be here.
Today, we're zeroing in on what drives stock returns. We're trying to move past, the usual factors.
Yeah, exploring something potentially quite important, but maybe a bit overlooked.
Exactly. We're diving deep, using the research paper, an augmented Q-factor model with expected growth by Hu, Mo, Xu, and Zhang.
It's a solid piece of work.
And our mission really is to unpack this idea of expected growth. What is it, and how does it help us understand the market better?
Right. We know figuring out stock returns can feel, well, overwhelming.
Totally. So we're going to pull out the key stuff for you, make it accessible.
Yeah, hopefully give you a clearer picture of what's influencing stock prices without drowning in jargon.
Yeah. Let's get right into it then. The researchers, they start with a core idea from investment theory, right? What's that foundation?
Well, the basic principle is that companies expecting to significantly grow their investments in the future, they should probably offer higher returns.
Even if their current investment, their current profitability, is just the same as some other company.
Exactly. Even if they look identical on paper today.
Okay, that kind of makes intuitive sense. It's about the future path, not just the snapshot now. Can you give us, like, a simple analogy?
Sure. Think about two coffee shops. Let's say they sell the same amount of coffee, make the same profit right now,
Okay.
but one shop, it's just got the funding, the permits, everything lined up to open 3 new branches next year.
Ah, okay. Big plans.
Right. That planned expansion, that expected growth, it signals something more, right? A potentially much brighter future.
So investors would likely be more interested in that coffee shop, expecting more profit down the line from the new locations.
Precisely. They demand a potentially higher return today for investing in that anticipated growth.
So it's this potential, this forward-looking element that current financials might miss. Which brings us to the big question. How on earth do you predict this expected investment growth?
Yeah.
It's not like you can just ask the CEO, right?
Hey, right. No crystal ball here. So the researchers had to get clever. They looked at several key indicators, things we can observe that might hint at a company's future investment plans.
Okay.
Then they basically checked historically how well these indicators actually lined up with real changes in investment later on.
So what were these main clues they looked for, these indicators?
Well, first, there's Tobin's Q. That's basically the company's market value compared to its assets value. Theory says a high Q should mean more investment.
Makes sense. If the market values your assets highly, you'd want to acquire more.
Then operating cash flows, the actual cash coming in from the main business.
Right, cash is king. More cash means more money available to reinvest.
Exactly. Strong cash flow gives you the means. And finally, they looked at the change in return on equity ROE, so recent trends in profitability.
The idea being, if profits are improving, maybe the company feels more confident to invest more soon.
That's the intuition. Improving profitability often leads to increased investment down the road.
It's an interesting mix. Market view, cash strength, and performance momentum. So how did these actually, perform? Did they work well in predicting future investment?
Well, the results were pretty revealing. They found that operating cash flows and that change in return on equity, those were quite strong predictors of future changes in investment relative to assets.
Ah, so cash flow and improving profits were good signals. What about Tobin's Q?
Tobin's Q. Well, it was a bit weaker on its own for predicting the change in investment. It might be linked to the level of investment, sure, but predicting the shift, less so, according to their findings.
That's a subtle but important difference, isn't it? Predicting when a company ramps up or down investment is different from its general valuation.
Exactly. And crucially, when they looked at groups of stocks, like portfolios,
Yeah.
their predictions for future investment changes based on these indicators actually matched up pretty closely with what really happened later.
Okay, so the prediction method seems, well, pretty solid at the portfolio level.
Yeah, it suggests their approach to estimating this expected growth was effective, at least in aggregate.
All right, so they have this way to forecast expected investment growth. How do they then turn that forecast into, like, a factor that explains stock returns?
Okay, so this is where they build the expected growth factor. They call it REG, R-E-G.
Reg.
Got it. They basically create it by sorting stocks. They rank stocks based on that predicted future investment growth we just talked about.
Can you walk us through that sorting process? How do they group the stocks?
Sure. It's a two-way sort. First, they split all the stocks into 2 big piles based on size. Small companies and large companies.
Standard practice.
Then, Within each size group, they sorted the stocks again, this time into 3 piles based on their predicted investment to assets change for the next year.
So low, medium, and high expected growth.
Exactly. Low, medium, high,
Right.
within both small and large cap. So you end up with 6 portfolios in total.
Right, 6 distinct groups. And sorting by size makes sense. Small firms might grow differently than large ones.
Precisely. It helps control for those size-related differences.
Okay, and the reg factor itself, how is that calculated from these 6 portfolios?
It's pretty straightforward. Each month, they look at the returns of those 6 portfolios. They average the returns of the 2 high expected growth portfolios, small and large,
Okay.
and they average the returns of the 2 low expected growth portfolios. The reg factor is simply the difference between the average high return and the average low return.
High minus low, based on predicted growth?
Yeah.
And what did they find? Did this factor actually earn a positive return? Was there a reward?
Oh, absolutely. A big one. They found a really substantial premium. Stocks with high expected growth consistently outperformed those with low expected growth.
How substantial are we talking?
The average difference, that premium, was about 0.84% per month.
Wow. Okay, nearly 1% a month. That's not trivial.
Not at all. And it had a very high statistic, which, basically means it's highly statistically significant. Very unlikely to be just random chance.
And crucially, you mentioned this premium wasn't explained by their original Q-factor model, the one with just investment and profitability.
That's right. The existing model, which already accounts for size, investment levels, and profitability, couldn't explain this extra return from expected growth.
So expected growth really seems like, well, like a missing piece of the puzzle. Does this point towards maybe market inefficiency? Like the market isn't fully pricing this expected growth.
Or it could be a rational risk premium, right? Maybe investing in companies planning big growth is just inherently riskier, and this is the compensation.
True. The research doesn't definitively say why it exists, just that it does.
Exactly. But the fact that the standard Q-factor model, which is built on rational theory, doesn't capture it, that strongly suggests expected growth carries important information about future returns.
And this finding, the strength of this new factor, led them to actually update their model.
Yes, precisely. Since the original Q-factor model was missing this dimension, they augmented it. They added this reg factor, creating what they now call the Q5 model.
So Q5 is just the original 4 factors: market, size, investment, profitability, plus this new expected growth factor.
That's the core idea, yes. 5 factors in total.
And then presumably they wanted to see how well this new Q5 model worked. How did they test it?
Oh, they put it through its paces. They tested it against a whole battery of known stock market anomalies.
Anomalies. Those are the patterns in returns that traditional models struggle to explain, right?
Exactly. Things like the value premium, momentum, accruals effects. There are loads of them. They looked at about 150 significant ones.
150. Wow. Okay. And the goal was to see if the Q5 model could make sense of more of these anomalies than the older models.
That was the test. Could adding expected growth reduce the number of these puzzling, unexplained anomalies?
And it's did it. How did Q5 perform?
It actually did remarkably well. The Q5 model significantly cut down the number of anomalies that remained unexplained compared to the original 4-factor Q model.
Okay, that's a win for expected growth. How did it stack up against other big-name models, like Fama French?
Yeah, they compared it to the Fama French 5-factor and even their 6-factor model, the Barillas Shanken 6-factor, the Stambo Yuan 4-factor model, several leading contenders.
Right.
And the Q5 model generally held its own, often outperforming these others in terms of reducing the number of significant unexplained anomalies.
That's quite impressive.
Yeah.
Can you give us an example or two? Where did Q5 make a difference?
Sure. Take companies with high R&D spending relative to their market value, research and development.
Right. Those often have lower reported earnings now because R&D is expensed.
Exactly. But intuitively, high R&D suggests future growth potential, right?
Makes sense.
The Q5 model, by explicitly including expected growth, did a better job explaining why these high R&D firms sometimes earn higher returns than models without that factor would predict.
Okay, that fits the story. Any others?
Another area was accruals anomalies. Companies with high accruals, basically, earnings not backed by immediate cash flow, sometimes underperform. The Q5 model helps explain this potentially because high accruals might mean lower operating cash flow, which, as we saw, is a key predictor of lower future investment, hence lower expected growth.
Ah, so the expected growth factor connects these dots. That's neat. It seems like looking ahead really clarifies some confusing patterns.
It does seem to add explanatory power. Now, it's important to say no model is perfect, right?
Of course.
The researchers aren't claiming Q5 is the final answer to everything, but they're highlighting that adding this expected growth dimension seems to be a significant step forward in explaining the cross-section of returns.
Yeah, it pushes the understanding forward. But there's this point. Expected growth itself, you can't just look it up on a balance sheet. It's unobservable.
Right.
They had to predict it. Doesn't that make the factor a bit shaky, dependent on their prediction method?
That's a really fair point, and the authors acknowledge it. The factor's performance does depend on the predictors they chose, especially, it seems, operating cash flow.
So if you use different predictors, you might get a different result.
Potentially, yes, but they frame it more as empirical dimension reduction. Think of it like this. There's lots of variation in stock returns out there.
Hmm.
Their expected growth factor, even though it's built on predictions, seems to capture and summarize a good chunk of that variation using just this one extra variable. They used historical data, looked at how things like cash flow actually did predict future investment over decades.
So it's empirically derived, even if the underlying thing is unobservable, using observable data to proxy for the unobservable driver.
Kind of, yeah. It's about finding observable patterns that consistently relate to future outcomes.
Did they check if the results changed much if they tweaked the prediction method? Robustness checks?
They did. They ran several checks. For instance, predicting the growth rate of assets instead of the change in investment to assets didn't fundamentally change the main conclusions.
Okay, that's reassuring.
They also tried adding other potential predictors into the mix, including past investment growth didn't change much either.
What about current investment growth?
Including current investment growth did affect things, but they think that's more of a mechanical relationship within the statistical analysis itself, not necessarily undermining the core idea.
So while the exact recipe matters, the general ingredient, expected growth, seems important regardless.
That seems to be the takeaway. The core concept appears robust, even if the specific construction details can be debated or refined.
Okay, so pulling it all together, what are the big implications here? How does this change how we think about markets?
Well, one thing is the efficient markets debate. Does a model like Q5 explaining returns mean markets are efficient? Not necessarily. Does the fact that characteristics predict returns mean markets are inefficient? Also, not necessarily. It's complicated.
Right, it doesn't neatly settle that old argument.
No. But what it does do, as the researchers emphasize, is offer a more concise way that dimension reduction idea, again, to understand the main forces driving average stock returns across different companies. It bundles a lot of information into fewer factors.
So the Q5 model, with this key expected growth factor, gives us a more complete, maybe more intuitive lens for looking at stock returns. It recognizes the future matters as much as the present.
I think that's a good way to put it. It brings in that forward-looking aspect that perhaps wasn't fully captured before and helps make sense of a broader range of what we see in the market.
Okay, so for you listening, if you had to boil this all down, what's the essential nugget to take away from this deep dive?
I'd say the key thing is a company's expected future investment growth seems to be a really crucial driver of its stock return. Maybe even more so than just looking at what it's investing or earning right now.
So think about future plans, not just current stats.
Exactly. This research gives us a richer framework by adding that forward-looking piece.
And for you, trying to stay informed without getting buried in academic papers, how might this understanding be useful?
Well, it encourages you, when you look at a company, to think beyond just the latest earnings report. Ask yourself, what signals suggest this company is poised for significant future expansion? How might that potential growth impact its value down the line?
Right. It shifts the focus a bit, encourages looking for those signs of future ambition and capability.
Definitely.
Okay, great point. And maybe a final thought for you to chew on, building on that. The researchers use specific indicators, Tobin's Q, cash flow, ROE changes. But how might you personally assess a company's future growth prospects? What other signs, maybe qualitative ones, might you look for beyond the standard metrics?
That's a really interesting question. What clues really signal future success? Something to ponder.
Absolutely. And if you do want all the details, we definitely recommend checking out the original paper, An Augmented Q-Factor Model with Expected Growth. It's got much more depth.
For sure.
Thanks for joining us for this deep dive. We'll catch you on the next one.